from the morning reading. Stocks are in the process of testing the buyers who stepped in early last week. This is typical behavior following sharp declines from a high. Up volume on the New York Stock Exchange was less than 5% of the total. This comes on the heels of at least one day that had less than a 10% up volume in the past 2 weeks. Of the 27 times this has occurred since 1962, the S&P 500 was higher 6 months later 24 times, averaging plus 13.2%. The only exceptions were during the depths of the financial crisis in 2008. A year later, the S&P was positive 26 out of 27 times, averaging 23.8%. The S&P has moved plus or minus 2% on 6 out of the past 9 days. Since 1940, this has occurred 9 other distinct times. All were higher a year later. Good morning. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:45 Central Time, and I am recording this in preparation for the market day of September the 2nd, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive into our overnight. And indeed, generally something of a bounce after yesterday's very weak action. All four of the broad market indices are up, with the S&P up about 0.4%, the Russell a little less so at about 0.35%, NASDAQ about 0.5%, as is the Dow. In terms of crude oil, down sharply about 2.25%, Euro down about 0.25%, bonds up about 0.4%, and gold at scratch. In overseas action, a little quieter coming out of China, down only 0.2%, Hong Kong down about 1.2%, Japan down about 0.4%, Germany up about 0.25%, and the United Kingdom at scratch. In terms of macroeconomic reports for today, you do have the factory orders and crude oil inventories, and ADP employment change. That'll be our precursor to the Friday monthly employment report. In terms of tomorrow, we have in the United States trade balance and the regular weekly unemployment claims. During market hours, you have the ISM non-manufacturing PMI and natural gas. In terms of current volatility conditions, you see the skew pretty high here at about 129. So that certainly is of note. VIX, short-term VIX, 31.21, also certainly elevated. IV percentiles also elevated. They're pretty much across the top third of the percentile range, with the SPX at 67, Russell 63, and the NASDAQ 66, and the Dow at an 80. We did put in standard deviation moves yesterday, a 2 standard deviation move put in by the S&P and by the Dow yesterday, and then the Russell and NASDAQ were frankly just below a 2 standard deviation. This was like a 1.9 in both cases. So big moves put in yesterday across all four of the broad market indices, and of course you see as the last 2 weeks, we continue to be a very high count and degree of volatility in these trading days of recent. So quite a bit of action going on there. In terms of the regular daily report, pretty much the same as we've had in recent days. Still phase 2 on our intermediate term phase opinion, trend breaking, our portfolio posture, metrics, IBD status, market and correction, accumulation distribution score on the S&P a D, NASDAQ an E. GMI index is a 0 out of 6, and that author is in cash. Primary market condition is a neutral bull, so certainly the weakest it's been in years. We do have an update on the stock charts decision point scoreboards, and you notice here the two boxes, the trend model signals and the long term have both turned negative, so even more red arrows now than there were before. In terms of the intermediate term market posture, we are weakly bullish. And we'll go into a little bit more detail on that. You see all four indices are actually signaling weak bulls, but these are decidedly weak bulls. Scores 35, 38, 48. NASDAQ the strongest, Russell the weakest at 26. But you put them all together, you know, this is calling for a weak bull on the intermediate term market posture. But there's an awful lot of stuff to go along with that. Position sizing opinions remain, both of them set at 0. And our hedge warning status still remains at level 3, which is our crash warning. This is the potential, saying that the risk parameters are there for significant downward movement. It's not a prediction of that. Though I will go ahead and pop over to the charts here and just show you a couple quick things. With the S&P, obviously we had the big range, we've had the break of the range, and then the waterfall cascade, the bottoming pattern, which was textbook, and then a 50% retracement, which is also textbook, and then a topping pattern, and the fall off from there. This is pretty much all, while none of these would have predicted perhaps the length of these moves, just how far they went. Pretty much textbook in that, you know, at this point right here, when you break this range, you're looking for significant potential for fall. Once you get that bottoming pattern come in, you'll expect that you'd have some bullish action. Then you get this pattern right here, and you expect that you'd have some topping action and then a fall back. Once this fell back through the 50% and especially through the 61.8, the prediction now, and I've seen a number of different authors all kind of speaking about this, is that we're going to test these lows. Now, getting there could be very, very, very volatile, and you know that doesn't mean it goes there today. It could even chop with an inside day, or maybe even have a little bit of a bullish candle. But at some point, the expectation of this kind of pattern is that we're going to go down and test this area. Doesn't mean we go exactly to this number. Doesn't mean that we undercut it. But probably within 1 or 2% of this area would be the expectation, and test these lows. Test these people who bought in this area, and test their resolve as to whether they're willing to defend that area again. So something to kind of keep in mind there. If you go to the Dow, very similar pattern. Obviously, most of these are all kind of following the same pattern at this point. The four indices really aren't different enough to make much of a case one versus another. All pretty much in the same relative patterns, and also all pretty much in an intermediate to even. You could start making even the case longer term patterns in a bearish pattern at this point. So back to our daily report. Let's take a quick look at some of the individual metrics that make up the opinion. Volatility base, market in decline, sharp increase warning, have fired. We're still VIX over 18. Distribution days obviously aren't being counted because we're a flat out market in correction. VIX days increasing, skew is above a 125, almost above a 130. You did have in the New York Stock Exchange yesterday an elevated new low count at 209, but not to the point that we normally get excited at the 300 plus level. I thought this was of some interest. Actually, 4 of the 5 risk aversion indicators have now flagged as risk on. So some of the first signs that perhaps oversold conditions are starting to come across. Option income strategies opinion, VIX is outside the acceptable window, so not a good time to be initiating new option income strategies. Same thing with cover call strategies, given current conditions, not acceptable to initiate new positions for novice traders. Aggressive traders probably should consider legging in using put selling. So consider, look for those bottoming patterns, at least in the stock that you're looking at or ETF that you're looking at. Look for those bottoming patterns. Consider scaling into positions, and consider using a spread instead of an outright naked put, given the current market conditions. In terms of sector specific, it's as red as it gets. This is as negative as it gets. And I should also note, while we spent weeks and months talking about, subtle differences here because the lines are so flat, that is no longer the case. These are angled deeply down and deeply separated. These are as negative as anything I've seen in quite some time. In terms of the percent change yesterday, very, very negative here. You see these, the best is at minus 2.12. This kind of goes to what we were talking about the other day, that, while you might point to utilities or healthcare, doing better on a shorter term basis, when the market goes down, it drags all sectors down, all industry groups down. Tide takes them all out, and you can lose a lot of money on these days. So just not a great place to be initiating new positions at all at this time. So should be enough for today. If you find what we're doing here is helpful to your trading, retweet us to your Twitter followers or your StockTwit followers. Like us on that YouTube channel, subscribe to that YouTube channel, all these various places you can find us on social media. We appreciate your acknowledgement. Feedback can be sent directly to support@falconglobaltraders.com. More information about what we do and how we actually put these concepts into practice can be found at this website. Disclaimers as always. Hit the pause button if you need more time to review this. And we'll see you back here tomorrow morning for the market preview from Falcon Global. Good trading.